If you do not know about open interest, you're almost guaranteed to trade an options contract that's going to cost you money. So I want to help you guys avoid that. We're going to cover exactly why open interest is important and exactly what it is. So open interest, simple. It's the total number of currently open contracts for a particular security contract and can be found on the options chain. All it does is it represents the total number of buyers and option sellers who have not yet closed their positions, so they're still out there. So for traders of options, it's a valuable metric. You can use it to gauge market activity and identify potential trading opportunities, especially which option strike price and expiration date that you should be involved in. So when open interest is rising, it typically indicates that new money is entering the market and traders are bullish or bearish on the underlying security. On the flip side, when open interest is falling, it can signify that traders are losing confidence in that market. They may be hesitant to open new positions. Just thinking about that, open interest can be helpful as you seek to navigate the market and decide which one you're going to trade. So many traders, they actually confuse open interest with volume, but they're two different things. So volume is going to represent the total number of contracts that were traded during some period. Open interest represents the total number of outstanding contracts that are still out there. So for example, let's say that 100 calls are traded today. 50 of those calls are new. The other 50 are traders who close their positions. So volume would be 100, but open interest is only 50. That's the new ones that were opened. So here in this example, you can see that the out-of-the-money strike price of $120 on the call side has the most open interest for that October 21st expiration date. So open interest is going to rise when new contracts are established that did not exist. So this implies that a new buyer must take a longer position and a new seller takes a short position, which results in a new market contract. So how do we calculate it? We just take the total number of contracts, subtract the total number of closed ones. So if there are 100 outstanding contracts and 10 expired, well, the open interest would be 90. So open interest can be a helpful indicator when you're making decisions because it does give you some insight into the liquidity and the strength of that trend. But the good thing is you don't have to calculate it. The Options Clearing Corporation, the OCC, they manage and clear all options transactions in the market. It's also in charge of keeping track of all open interest for options traded on exchanges. And on their website, it says that they clear millions of contracts a day. They have a key role in the world's largest economy. In fact, we are the only company that clears and settles every listed options trade in the country, so that's pretty large. So how do we use it? Well, if open interest is rising on the call side or put side, it just means that more money is entering the market, and that just means more buying selling pressure depending on the current trend direction. Declining open interest, the market's liquidating. It could mean the prevailing trend is either set to reverse or pause. But keep in mind that for every contract that's created, there's a buyer and a seller. One of them is wrong. Now, open interest, not the only factor you should consider, but I think it's a helpful tool when you're making certain decisions. So why do most traders that trade options prefer a high open interest? Because those numbers that are higher usually relate to greater liquidity. And I think this is vital. It gives you confidence that the price that you want to enter and exit at generally is going to be met. Trading an illiquid option market, not something that we suggest. So we have a rule of thumb. We look for 25 times the amount of open interest compared to the contracts that we're going to trade. So if we have one options contract that we can trade, we want to see at least 25 in open interest. So in an example with the $120 strike price, we could buy 10 contracts. But there are limitations. Okay, it's only updated once per day. So it's not a reliable indicator of action if you want up to the minute updates. That number is only valid at the opening of the trading day because it's going to change throughout the session. And that number for today will be posted tomorrow. And also, it can be affected by rollover activity or contract expirations. Okay, so take those limitations into account when you interpret the open interest information. So wrapping it up, it's pretty simple, right? It's the number of active contracts of a particular security that exists at any given time. We can measure market activity, we can measure liquidity, and generally as well as investor sentiment. A high level of open interest could mean there's a strong support for the current direction. Low level of open interest potentially means weaker interest. We could use open interest to identify the trend in the market to confirm price movements. So if there's high open interest on the call side at higher strike prices, generally Traders are looking for that price to rise. This is Baidu, and I want you to note that that is the $120 strike price that we talked about. It's close to being met. When I took this graphic, when you're watching this video, it might have already been hit. But it can also be used to generate signals, right, with some strategies. So let's say you have rising open interest in call options. Well, for some traders, that's bullish. While a falling open interest in put options, they might be thinking bearish, and they'll take that information and use that as part of their strategy. But again, don't use it in isolation, right? You got to use it in consideration with other things. Ultimately, open interest, just a tool. It's going to help you gain insight into the market. When you use it properly, I think it's a valuable addition to your toolkit when you trade options. And speaking of trading options, look, it can be a little bit scary at times. We know that. We actually put together this free guide. We call it our dynamic duo guide. You're going to find 2 high-performing markets, plus we're going to talk about a one-day options trading strategy. That means you trade it today, exit tomorrow. It's a simple plan. It's a free download. Link is above or below. Hit subscribe, like this video. We'll talk to you soon.